to where they want to go. I am going to share my screen now so that I'm going to start my presentation, and we will move forward with that. And like Ann said, please save any questions till the end, and we can go from there. So the 1031 exchange is, in my opinion, the Swiss Army knife of real estate. It allows people to do things and get to places in their lives that meet their goals, to make or generate generational wealth, to get to a retirement or estate planning that allows them to take advantage of their real estate and their appreciation over time to be a very powerful option for their generation and the next generation that are coming along. And it's so powerful, but what really needs to happen is people need to plan ahead a little bit or understand these concepts so they can act accordingly and within the rules and use 1031 just to get them to where they need to be. And today we're going to talk about the basics of 1031s and how powerful that can be and what the rules are, so that if you do follow all the rules, it's called the safe harbor, that the IRS provides their point of view is a presumption of validity, that if you do an exchange, you stay within all the rules, they're going to say, oh, everything's fine, and you guys can do this and defer your taxes. And we're going to start now by looking at the language
David?
That is in the IRS code. Yes.
I'm sorry, I just want to quickly ask everyone whether everybody can see David's screen share.
Yeah, I can see it.
Okay, good. Okay, good. Oh, good. Okay, we can proceed. Sorry for interruption.
Okay, great. No problem. So here is the language that has created the 1031 exchange, and no gain or loss shall be recognized in the exchange of real property held for productive use in a trade or business or for investment if such real property is exchanged solely for real property of like kind, which is held to be either for productive use in trade or business or for investment. And that's the language that has created the ability to do 1031 exchanges. Now, the 1031 process used to involve personal property as well, but the Jobs and Tax Act of 2017 changed 1031 so it was only for real property or real estate. And another factor that comes into play frequently when people talk about 1031 exchanges is that, oh, it's a tax-free exchange. It's not a tax-free exchange. It's a deferral of tax, of capital gains tax that in some situations can be turned into a tax-free situation. But we'll go over those. We'll go over those options as we go through the presentation. The history of 1031. The history of 1031 started back over 100 years ago when the United States was in World War I. They needed to pay for it, and they decided that they had to tax, and they taxed the wealthy of the United States, and the wealth that they taxed, they said, after a couple of years, well, how come we're the only ones paying the bill? And they decided that in 1921 that they gave the option of a non-recognition of gain or loss in certain circumstances, which became the precursor to the current 1031. The act of 1921 was limited. It excluded stocks, bonds, and other assets that couldn't be 1031, but it involved personal property up until 2017, as I mentioned earlier. And the rules about the time limits on 1031 exchanges were non-existent. And the case that generated those limitations happened in 1979. It was Starker versus the United States. And the situation there was the gentleman Starker had a piece of property that a corporation wanted to buy. And he said, okay, yeah, I'll sell you the property, but don't pay me the money. You hang on to the money. I haven't figured out what I want to buy yet. And when I do, I'll tell you what that is. And you go buy that property for me and you provide that to me. Well, it took him 5 years to find his replacement property. And the IRS didn't like that. the IRS said, whoa, you can't wait 5 years. You can't wait 5 tax returns to do your exchange. It has to be done quicker than that. Well, the court disagreed and said, nope, it's a tax deferred exchange. The IRS didn't like that because they lost. And so in 1984, they changed the time frames for 1031 exchanges into the time frames that still hold today, which is a 45-day identification period and 180 days to finish the exchange. And we'll go over those deadlines as we go through the presentation. Now, an exchange is no longer an actual swap. What people could do in the past is say, you know what, I want your piece of property, you want my piece of property, here's my deed, here's your deed, and that was considered an exchange. Well, that's very difficult these days for somebody to say, oh, I want your property, you want my property. It's kind of a needle in a haystack situation. So it became much more widespread. And in the 80s and 90s is when 1031s really did start to gain traction and become much more used throughout the United States because it is such a powerful tool. Now, the 1031 exchange is some degree a legal fiction because it requires certain structures and certain setup that is required by the IRS. Well, that's what we do as a qualified intermediary. Our exchange documents actually create the transaction and the exchange, and that's very important that those documents are in place when you close on the property that's being sold, and that allows for the capital gains tax to be deferred. But people don't understand that it's not just capital gain tax that gets deferred. Anybody who's owned investment property for any period of time takes advantage of what is known as depreciation. Straight line depreciation for a residential property is 27 and a half years. For a commercial property, it's 39 years. And when you sell a commercial or investment property, residential or commercial, the IRS wants 25% of what's been depreciated back at that sale. So here in New York, you'll find that that can increase the tax burden upon sale, in addition to the transfer taxes and other expenses that aren't part of the deferral. But nonetheless, that is a big portion, along with the federal, state, and city taxation. And I'll get to those numbers also a little bit later in the presentation. Now, when we talked about the statute, the language that creates 1031 exchanges, people say, well, how long is necessary? Well, the IRS views the intent when somebody decides to own a piece of property and hold it as an investment. Are they intending to hold it as an investment property? And the way the IRS measures that is over a period of time. And the industry for many years, 30 years, has said that the amount of time that you need to hold the property is 2 years. Well, that's not in a statute anywhere. That's not stated in any regulation, but it's always been kind of the fallback, most conservative point of view. You can do a 1031 exchange if you hold the property for less than 2 years, but generally speaking, the IRS would take a hard look at that, because if you hold the property for less than a year, those aren't actually long-term capital gains, that's short-term capital gains. And they would want to know why you were doing a 1031, because if your intent was to hold it as an investment, they expect that to be over a period of time. And if you have a good story as to why, like you bought this piece of property and you had an unsolicited offer that came in and you're like, well, I can't turn that down. That's too good of a deal for me. Well, you have a business reason, and there is a possibility that you could do a 1031 exchange and you can justify it to the IRS and they'll be okay with it. Now, the second portion of that process and that statement of regulation that structures 1031 exchanges is what is like kind. And like kind is sometimes misunderstood, but it has to be held for use in a trade or business or held for investment purposes, meaning that it's rented out in some way, shape, or form. But if you're holding a piece of raw land, that's not going to be rented. But if you're holding it because you expect it to appreciate in value, because it's right next to a expanding municipality. And once the municipality says, oh, we're going to expand the size of our municipality and it's going to take over that piece of property could increase in value quickly because it could have access to services. It could have access to sewer and water that the city or municipality provides, and that's an increase in value and makes that property more valuable. And that the reason that it was purchased was because the expectation of appreciation. So that is held for investment purposes. Now we have an example. We had a client many years ago who was selling a 6-unit apartment building, and he had decided that I'm going to sell my building and I'm going to purchase a 5-unit apartment building. But he thought to himself, well, if I'm going to buy this 5-unit apartment building, it's not like kind because it only has 5 apartments, not 6. So when he told us that he was doing a 1031 exchange and that he already found his replacement property, but it was only a 5-unit building, but he told us not to worry. He had already spoken to the owner of the replacement property and that he was going to add an additional apartment. So it'd be a 6-unit building for a 6-unit building. And then the question was, well, are you going to paint them the same color? Because then they would be truly like-kind properties. Well, in fact, he didn't have to do any of that because a like-kind property is not just an apartment building for an apartment building or industrial for industrial. It's for any type of property that's held for investment or use in a trade or business. So when we look at what is like-kind property can be office, industrial, vacant land, as I mentioned before, multifamily, single-family homes. Here in New York City, we have special rights that are considered real property, and those are easements and air rights. Air rights being the operative term there, because New York City recognizes air rights as real property. I've had clients who've sold air rights to developers, and they 1031 the purchase of those air rights into other properties. That was other multifamily because it was a great down payment. And he was like, well, that's perfect for me. I'll take the $400,000. That'll be my down payment. And I'm going to buy this 3-family property over here. And that's a valid 1031 exchange. The other one I didn't mention is retail. But again, everything is on the table if it's held for use in a trade or business or if it's held for investment. Now, you have to receive but nothing but like kind in return. So is the property that you're purchasing, is it held for resale? So the example here is vacant retail. So the developer built vacant retail and now wants to sell that vacant retail. Well, can they do a 1031 exchange? Well, no, they can't because they built that vacant retail to sell to somebody else who's going to lease it out and operate it as a business. So that does not qualify for a 1031 exchange. The same thing would happen for a developer who buys a piece of property that he's going to put 10 houses on. He's not buying that piece of property to sell, to hold as an investment. He is buying that piece of property to develop into single-family homes that he's going to sell off one by one. So he can't do 1031s with any of those developed properties or finished single-family homes because they were built to be sold. They are inventory. Now, if that developer had built that retail center and then rented it out to tenants and held onto it for a couple years, then it becomes an investment property. He held it for investment, or she held it for investment. So that is a valid 1031 exchange, and that property does qualify. Another question I get quite frequently is a single-family home. Can I do a 1031 out of a single-family home? I hear this probably once or twice a month, and the answer is no if it's your personal property. If you are living in that property and it's your personal property, well, that doesn't qualify as a 1031 because it's not held as an investment. That's your primary residence. You can't do a 1031 out of a primary residence. So that doesn't work. But if it's a single family property that's rented out, you're holding it as an investment. It's being reported on your Schedule E that you're getting income from this property, then in fact, that does qualify for a 1031 exchange. And that's very important. And these are little misconceptions that people don't understand sometimes. And I'm happy to clear these misconceptions up. Now, the next topic we're going to look at here is primary residence and 1031 exchanges. And I just said that you can't use personal property in a 1031 exchange. Well, the example I'm going to go through now is on the right-hand side of the screen. You can see that the owner has a fourplex. And one of the units is their primary residence, and they rent out the other three. Well, can they do a 1031 exchange? Yes, they can actually. They can do a 1031 exchange with 75% of the property. And then their primary residence, because they live there, they can use the 121 exclusion, which allows for an individual to take $250,000 in cash tax-free out of the exchange, or if they're married, $500,000 out of that sale. Now, generally speaking, it's proportional to the amount that the building is sold for. But if we use this example that this fourplex is worth $2 million, each one of the units is worth $500,000 in proportional if things are done by square footage or by number of units. So the couple, if their unit is worth $500,000 out of this sale, that $500,000 they take out of that property is tax-free, and they can defer their capital gains on the other 75% by selling that property and purchasing replacement property with the funds from the 75% of that sale. So that is an aspect of 1031 exchanges that most people don't realize. And this goes back to my Swiss Army knife analogy, that people can, if they know enough about these rules, they can use the 1031 as a very flexible tool to get to where they'd like to be. The next topic I'm going to talk about are vacation homes or second homes as a replacement property. The IRS views vacation properties as personal property and investment property. So you can have a vacation property out at a beach, on the Jersey Shore, out in Montauk, that if you limit your personal use to the IRS rules, it's valid to be used for a 1031 exchange. Now, the personal use limitation is 14 days or 10% of the amount of time that it's rented. If somebody rents the property out for 300 days a year as an Airbnb type situation, then they can use the property for 30 days a year. And that's extremely valuable, and that's extremely important, because that, they get the dual benefit of personal use, and they can 1031 that property, even if it's only 14 days. I had a friend of mine who, he and his wife owned a vacation home down in Sea Isle in New Jersey on the shore, and they used it for the 4th of July and Labor Day, and the rest of the time they rented it, and that time frame more than paid the mortgage on the property. So that property was a viable 1031 exchange property. And one of the other things is, they always get asked the question, well, how would the IRS know that I was there? Well, the IRS is very good, much like New York State is, about tracking where cell phones are. New York State does it because people who move to Florida say, well, I live in Florida now, so I don't pay New York State taxes. Well, New York doesn't like that. And if they can figure out that you are spending 6 months in a day in New York and not 6 months in a day in Florida, they're going to hit you as a New York taxpayer. So that's very similar to this with a vacation home. But the interesting fact here is that if you go down to that property to do maintenance on that property, to clean it up, to do things in between times that it's rented, that's not considered personal use. That's just you maintaining it, and that's a business purpose visit. So those don't count against the 14 days or the 10% usage of the rental time frame. Now, a conversion of a replacement property to a primary residence. This is a question that I think is starting to come up more and more, and is a very valuable option that people don't realize. So let's say somebody, I had a client who did this many years ago. He sold his multifamily property in New York and bought 3 houses on a golf course in Florida. He retired 2 years later after the sale and moved into the first house. He lived there for 2 years, and then he sold that property, took his 121 exclusion of $500,000, he and his wife, and they moved into the second property. They lived there for 2 years, sold it, and moved to the third property. So the fact is that he spent the final years in the third property, but he got over $1 million. He got $1 million out in the 121 exclusion by owning the first 2 properties. The IRS recognizes this and they're okay with it, but they did change the law, the regulations. I can't remember when, but it was not too long ago, where you have to own the property for 5 years prior to getting the 121 exclusion. So in the example I just used, if he retired 3 years later or lived in the first house for 3 years, he would have had no problem getting the full 121 exclusion from that property. This is a very powerful tool, and this is great for somebody who's thinking, you know what, I want to retire, I'm going to buy a house down in Myrtle Beach or on the Carolina Shore or in Florida, and that's my ultimate goal. You wait 2 years after renting it out, and it can become your personal residence. So powerful. So 1031 exchanges can also be done with less than a fee interest in the property. So I recently had a case where the owner had a 32-year lease, 32-year lease on an easement on a property that had a cell tower on it. She was able to sell that lease to a cell tower company and 1031 the proceeds into a property in Florida. She had over 30 years left on her lease on that easement, and as such, that qualified for a 1031 exchange. It was recognized as real estate under the 1031 code. A vendee's interest in a land sale contract, so somebody who has the interest of buying a contract on a property, they can 1031 out of that as well. Undivided fractional interests in a property. So let's say you own 50% of an office building. You can sell 50% of that office building to somebody and 1031 out of that into a property you own 100% of. And as I mentioned before, air rights, easements, development rights, conservation easements, they also are considered real estate under the IRS code. So they qualify to be part of the 1031 process. And that is so important. And what the IRS, while they have made regulations that indicate what is considered real estate, state law is very important as well. And they recognize state law that recognizes what is considered real estate. So here in New York, air rights are considered real estate because state law says they're real estate. So the IRS recognizes that. And there are some states that have other types of real estate that consider other types of property interests, such as out west, water rights are considered real estate. And as such, you can sell water rights in the western part of the United States, where states recognize water rights as real estate, and do a 1031 out of that. And there is an entire industry in the western states that have water issues that allow for 1031 exchanges out of water rights. And that's very, very important for those areas. What is like-kind fractional interest? It's undivided fractional co-ownership. So it tends to be set up as tenants in common. And tenants in common gives the ability to be flexible in the ownership structure because it's owned 50-50. This happens frequently with with cousins or siblings or two generations where one generation owns part of it, another generation owns another one. Those are considered interests in real estate. Then there's tenants in common, or TICs. This was an investment vehicle that was probably one of the first fractional passive investments in real estate that grew up in the early 2000s and became very popular. So people could buy fractional interests in grade A office space, industrial, multifamilies. But that kind of went by the wayside because the TIC rules made financing very difficult and also required 100% unison by the TIC holders, and was limited to 35 entities to be those TIC holders. That wasn't enough flexibility, and it was also regulated as a security, which gave rise to the next option, which are DSTs, or Delaware Statutory Trusts. The Delaware Statutory Trusts were approved in a 2004 ruling that gave much more flexibility for fractional ownership. It's set up by a sponsor. It allows much better financing. It doesn't have the same restrictions. And right now, I would say that DSTs are the most popular fractional interests and are very active in the 1031 world for people who don't want to deal with the 3 T's any longer: tenants, toilets, and trash. They can do a 1031 into a fractional interest in Amazon warehouses, in a portfolio of multifamilies in the Southeast. With the Southeast United States growing so quickly because of their population growth and tax structure, Florida, the Carolinas, Texas is a big one. I would say Tennessee. And Texas, Tennessee, and Florida all have zero income tax in their state. They have become very popular destinations for individuals who are looking to get a fractional interest in something that will pay them money every month. Call it mailbox money, but in this day and age, it's wired into the account. You don't have to go get a check out of the mailbox, but nonetheless, it's very powerful, and that is a huge industry into itself. Now, frequently I'm asked why they want to do 1031 exchanges, what's driving their desire to do a 1031 exchange. Well, if somebody owns here in New York City, anybody who owns real estate here in New York City, it's becoming more and more onerous. There's more regulation. The statutes being passed in Albany, among those being done here in New York City, have become very onerous on owners. In 2019, the state passed a statute that required rent stabilization to be very restrictive, and as such, reduced the value of those properties by 25, 30, sometimes even 40%, because you can only do so much with the property after somebody vacates. You can only get so much money back. I think it's limited to $15,000 over a time frame. That no renovation of any property here in New York City is ever going to cost less than $15,000. So you're not going to get your money back from that, from the rental income derived from the upgrades on the property. So, management relief and dealing with that. Consolidation. People don't want to have 5 buildings anymore. They want to have less of the tenants, toilets, and trash, as I mentioned earlier. Also, people don't necessarily just want to be in one market. New York City is a difficult market, a lot of regulation, a lot of violations, issues that people just get tired of dealing with. And as they're looking towards retirement, or they're looking towards what their next deal is, maybe they want, maybe they've owned the property to the point where they no longer can depreciate it. They can no longer have that write-off every year. And as such, they're now looking to restart that. And a 1031 can allow for that, because you can sell a $5 million property and purchase a $10 million property. Well, the first $5 million has been depreciated, but now they can start depreciation on that second $5 million. And that's incredibly valuable. And that's one of the reasons people own real estate, is because of that tax treatment is very advantageous to the owners. The next bullet point, cash flow. You know, when I talk to owners here in New York City, I hear cash flows in the 1, 2, 3% range. You know, they would like to see a better return on their investment, or the amount of funds that are in the real estate, held in the real estate. And you know, you can do a 1031 out of a property in New York into what is known as a triple net property. And this is also a very large industry that's grown up over the last 20 years. And you see triple net properties all over the place. Banks in parking lots, fast food locations, what else are Home Depots. There are these properties, these triple net properties, you know, they will pay a cap rate of 4, 5, 6, 7%, depending on the risk. The more risk of the triple net, the higher the return. But you have McDonald's and Chick-fil-A's, which are very, very popular, but they have investment grade credit on them. They pay in the 4 to 5% range, but that's still more than that is being developed here in New York City. So you can sell a property in New York City that is a 3 cap and go buy one for a 5 cap. That means you just increased your income on a monthly basis. That's incredibly powerful for, you know, who doesn't want to grow their income. The next topic, retirement planning. You know, this was kind of touched on with, oh, well, if I buy a replacement property in someplace I want to retire, well, I can have that property rented out for a couple of years, and then when I retire, I can move into that property. Well, you know, that's a great option. And then the last topic here is estate planning. Somebody, you know, is getting up there in years, and they have to figure it out. The kids don't want to go into the family business and run the multifamily property, the 70-unit building. So what are the options for estate planning? Well, let's say the owner has 4 children. They can sell that 70-unit building and go buy 4 separate properties in a more tax-friendly state. And when they pass away, they can move that they can allow each one of their children to inherit each one of those properties. And now they've effectively split up their estate and passed it on to the next generation. And they've done that in a very powerful way using a 1031 exchange. And I'll talk about that in a second. But why do people want, you know, what are some additional benefits of 1031 exchanges? Diversifying by tenant, property type, or geographic area. So sell a multifamily here in New York, you do an exchange, we hold the money, then you go buy 2 net lease properties in a strip mall, because they're going to have a better return, and they're not all going to be in one market. You could have the Wendy's in Florida, the CVS in Texas, and the strip mall in Tennessee. And that is very powerful. So you're now no longer in one market. If something hits that market, or there's a problem in that market, you only take it 1/3 hit as opposed to 100% hit. Retirement planning, I kind of went over this. You can sell the building, provide the money to a QI, buy a couple net leases, and then the residential house that you rent out for 2 years, and that becomes your primary residence, and you're still getting income from the other 2 net lease properties. It's a fantastic option. What are some other additional benefits? Well, you can leverage your investment. Now, frequently when people do 1031 exchanges, you know, after they've owned the property for quite a while, they say, hey, you know what? I want to take some money out of the exchange. Well, that is completely allowable. That is what is known as a partial exchange. And the example we have here, you sell a $5 million building. We get $4 million of that. You turn around and you buy a $4 million property, and you take $1 million out of the exchange. You can do that at the closing of the sale, that $5 million property. $1 million goes into your pockets, but after you pay your taxes on that, that really is only worth $650,000. So, that's the 33, 35% tax hit that you take. And that's a viable option. And that's one way to do it. But another way to do it is you sell that $5 million building. You send all the money to the qualified intermediary. You buy a $5 million property with it. And let's say there's no debt on the property. Well, you can refinance that replacement property and take that cash out tax-free. And the income from the property pays back that debt. And instead of paying $350,000 to the government, you take that money and the building still pays off that debt. And you take $1 million out of that property tax-free. That is a valid approach to a 1031 exchange. And I've kind of gone over this, the restart or increased depreciation, sold a $4 million building, purchased a more expensive building. And as such, you now bought that building for $6 million. So now you can start depreciating that additional $3 million. That is a fantastic option, and it works very well. You increase depreciation, and you get the mortgage rate arbitrage. Well, in this day and age, the mortgage rate arbitrage is maybe a little bit less because of the current environment for mortgage rates, but that's still a tax deduction on the mortgage interest paid. So that's still an option. Now, here is really the intergenerational option for benefits of 1031 exchange. So the common statement in the industry is you can swap till you drop. There's no limitations on the number of 1031s you can do. And as such, you sell a building for $5 million, $2 million basis, $3 million gain. You buy a replacement property for $5 million again, and then you die. Well, the heirs now receive a $5 million basis in that property. They inherit that property for $5 million. They turn around and sell that property. They don't pay capital gains tax. And I can give you a personal example. When my grandmother passed away, she left her last rental property to the grandchildren. She had 5 grandchildren, and that was how she was planning on being remembered, I'd be willing to bet. She was able to keep that asset. That was her last sole form of income. And when she passed away, we received that as grandchildren. These numbers are real. We sold that property for $250,000. And at the closing table at the title company, we were sitting there and the title company said, oh, well, before we can write checks after the sale, after the closing, we have to withhold taxes from the proceeds. And I said, whoa, wait a second. That's not true. We inherited this from our grandmother 4 months ago. The value has not changed. And as such, we don't pay any taxes. And each one of the grandchildren walked out of that closing with a $50,000 check. And that in turn has allowed my sister and myself we invested that $100,000 in real estate. And my grandmother, unbeknownst to her at this point in time, she helped grow a multi-million-dollar portfolio of real estate because of those funds that she passed down to my sister and myself. And that's what is available to everyone. That is the option. And I think my grandmother would be very proud of the fact that that's what we did with the proceeds from that exchange. From that transaction. So that is one of the most powerful things about a 1031 exchange is taking care of the next generation or even the generation beyond that, because that skipped my mother and my uncle. It came straight to us as grandchildren. Very powerful. So this next slide talks about the rules to do a complete deferral. And these are very straightforward. And the fact of the matter is that you need to replace the purchase of the replacement property has to be equal or greater value to the relinquished property. You have to reinvest all the net proceeds from the property into the purchase. Obtain greater or equal financing in the replacement property. So if there was $1 million of debt on the property sold, there has to be $1 million on the property that is being the replacement property. and receive nothing except like-kind property in the transaction. Now, one of the things that in the financing aspect of things, let's say you want to sell the property, it has a $500,000 mortgage on it, but you don't want to have debt on your replacement property, and you have $500,000 that you plan on using to pay off that loan. Well, you can pay off that loan or add that money to the exchange, and you don't have to have debt on the replacement property. You can replace that debt with personal funds from another source, and that will allow for a complete deferral of a 1031 exchange. And one thing that I'd like to add to this list for a complete deferral is using a qualified intermediary. Sometimes there are situations where attorneys talk about how they can be your qualified intermediary. Well, if they have represented you over the last 5 years, they cannot be a qualified intermediary for you, because that makes them to be considered an agent of you, the taxpayer or exchanger, and they are not allowed to be a qualified intermediary for a exchange. So that's just something to keep an eye out for, because sometimes there's a misunderstanding about that, but you have to use a qualified intermediary, and that's somebody who hasn't been an agent or involved with you. So greater example of greater or equal value. So sell for $5 million, money goes to the QI, you buy a replacement property for $5 million. Now, it's reinvesting all the net proceeds and the debt. Well, when you sell a property here in New York City, you have expenses. And in this example, we're showing $250,000 of expenses on a sale, and that's probably right in the neighborhood. So when you sell that property, you take the equity, $2.75 million, and you move that over to your new property. And then you take the mortgage, you move that over to the new property. That slide doesn't exactly flow very nicely. So the fact that you had $250,000 in expenses on the $5 million sale means that for a complete deferral, the replacement property only needs to be $4.75 million. So the expenses from the sale reduce the amount of the replacement property requirement. So an expense of $250,000 means that a $5 million property can be exchanged into a $4.75 million property, and that's still a full deferral, a complete deferral of 1031. So the next, we're going to do a little bit of math here, and I'll go through this, but the fact is, this is how you can figure out the capital gain and exposure on a property that you own. But I really do recommend getting your CPA or tax person involved, because this is a quick and dirty look at the numbers, where there might be some nuance in how things go, and especially when you bring in depreciation and capital improvements. When that's done on a property, that affects the basis. But capital gain is basically the sale price minus the expenses minus the adjusted basis. Well, the question becomes, what's the adjusted basis? Well, the adjusted basis is how much you paid for that property originally, minus the depreciation you've done over the years, plus capital improvements. So we're going to see the numbers here to calculate adjusted basis. So let's say the cost basis in the property was $900,000. Then that's had $100,000 of depreciation over the years of ownership. So the adjusted basis drops to $800,000 in the property, because that depreciation reduces the basis in the property. So then you have $800,000 of depreciation, but over the ownership, you put $200,000 of capital improvements into the property, which then increases the basis up to $1 million. So these are things to think about when you're doing it. I was just talking to my wife about this in relationship to a property their parents own, that they really need to figure out what their basis is in the property, because they're thinking about perhaps selling it and moving into a different type of asset out of a multifamily. Well, they need to know this information so they can make an intelligent decision as to what their exposure is and how they should go about selling the property and what their tax exposure is. And knowing what your tax exposure is when you're selling a property to a pretty accurate degree is important, in my opinion, because then you know what the numbers are, you know what your exposure is, what your capital gains would be. And so I think it's very important to know this information and be able to figure it out on a property prior to selling it or going under contract, so you know what the numbers are. So we're going to calculate a capital gain here. So the property is being sold is $4 million. The adjusted basis is $1 million, as we saw in the last example. So $3 million is capital gain. Well, at the federal level, that $3 million of gain is going to be taxed at 23.8%. And I frequently get the question, but wait a minute, the top capital gains rate is only 20%. Well, there's a net investment NIIT, net investment income tax. Net investment income tax, that's what it's called. And that is what has been used to fund Obamacare. And that 3.8% gets added on. So the amount of tax is based on 23.8%. So on $3 million of gain, that's $690,000 plus. With the additional federal depreciation recapture, remember in the last example, there was $100,000 of depreciation. So the IRS wants 25% of that back, or $25,000. So that's the federal amount of income tax, which is over $700,000 at this point in time. Now, New York State capital gain tax is 8.82%. So now New York State wants $264,000 plus in there for their taxation. And New York City, their capital gains tax is 3.88%. So there's another $116,000 that it needs to be taxes if an exchange is not done. So the total tax due on this $4 million sale is just over $1 million, with an effective tax rate of 36.54%. This is what a 1031 exchange allows to be deferred. That's $1 million savings that can be reinvested in replacement property. That is a very powerful aspect of 1031 exchanges. So here it is laid out again, and again, there is the tax due from this sale, which, if you look at the numbers, if you do a sale versus exchange, so let's say you're trying to do a four-time growth in investment to restart depreciation. If you sell it and buy a replacement property at that 4 times your amount, you can buy a property worth $4.8 million. If you don't do that, if you do an exchange, you don't pay that, you defer the taxes, you can buy a property worth $7.3 million. That is really one of the most powerful aspects of 1031 exchanges, that the amount of reinvestment funds is just phenomenal with an exchange. Now, the term boot is not defined anywhere, but boot is basically any amount of funds taken out of the exchange or not matched. So when we talked about that example where they wanted to take $1 million out of the exchange, they had to pay taxes on that. That $1 million that they took was considered boot, and you pay tax on any amount of boot. Now, boot can be cash that can be taken out, or if you don't get the same amount of debt financing on the replacement property, that is considered boot as well, and you would pay tax on that as well. So those are what is known as partial exchanges, and those are just as valid, but you have that tax exposure, and boot is the tax exposure that you pay taxes on. It's an option, and it's sometimes boot is going to be developed no matter what, but it's just good to know that. And that goes back to my statement earlier about knowing all of the financial aspect of your property so that you know what to expect when you're doing a 1031 exchange, or if a 1031 exchange is even something that is the right option. I've had people contact me about doing a 1031 exchange, but when they told me that they had inherited the property from their parents or partially inherited from their parents, the fact is they got a stepped up basis. They don't have a need to do a 1031 exchange necessarily. And that's something they really need to go over with their tax advisor, because if there's no reason to do a 1031 exchange, there's no reason to. If it doesn't work out financially and there's very little or any tax to be paid, you don't need to do a 1031 exchange. And I have no problem telling a client that, because that's what's important. Here is an example of an exchange cooperation clause. So when you're going into a sale of a property, you should talk to your attorney and let them know that you're considering a 1031 exchange as an option. And as a matter of fact, it would be my opinion that every commercial sale contract should include an exchange cooperation clause, because it just requires the buyer of that property to cooperate. And there's no cost to them, but they do have to sign what is known as a notice of assignment. Because of the structure of 1031 exchanges, the qualified intermediary assigns into the sale of contract. And as such, the buyer needs to know that and needs to acknowledge that, and the regulations require the buyer to acknowledge this by signing a notice of assignment. And if the buyer says, no, I'm not going to sign it, but if you have this clause in there, you can tell them, well, but you signed the contract that says that you cooperate, and all you need to do is sign this piece of paper. But even if they don't want to, you can slide it across the table at the closing and say that they were given notice and they just decided not to sign it. But this is an example of a cooperation clause that should be in a contract if you're planning on doing a 1031 exchange. Now, I mentioned this earlier. Now, exchanging in the safe harbor. And I always recommend exchanging within the safe harbor, because if you do that, the IRS gives that transaction and that exchange a presumption of validity, meaning that they are going to view it as a valid 1031 exchange. Use a qualified intermediary to create the exchange documents and transaction, hold the proceeds, and there's a secure exchange proceeds. So that's the issue there. Now, the timelines for a 1031 exchange are very important. And one of the things that I always recommend is to plan ahead when you're doing an exchange. And here, this slide is an example of a full circle of an exchange. The exchanger sells the property is deeded to the buyer, the sales proceeds go to the qualified intermediary, we hold on to the funds. When the exchanger is looking to purchase their replacement property, we wire those funds to that transaction. The seller deeds the property directly to the exchanger. Now, in the timeline here, you'll see it starts at 0. And 0 on the left-hand side of this diagram, that's the day of closing. That's when the clock starts ticking for 1031 exchanges. And you have 45 days to identify your replacement property. Now, I recommend never waiting to the closing to start looking for your replacement property. Here in New York City, when you go under contract, there's usually 30, 45, 60 days until you sell that property. Well, I recommend that that's when you start looking for your replacement property. And especially in today's environment, with it being such a tight market, that finding replacement properties can be somewhat difficult. But you can find that inside the time frame before you even close and go under contract on a replacement property. Thus, you then know that your replacement property is basically identified and you're under contract, but you can't close on it prior to the closing of the relinquished property. But you could close the day after. And as a matter of fact, the example I mentioned earlier, where the lease was exchanged for a property in Florida, the 32-year lease was exchanged for a property in Florida. They closed on the sale in the morning, and they closed on the replacement property in the afternoon. So that exchange occurred inside 8 hours, which was fantastic for the exchanger. They loved that. Now, the 45-day rule, we include a form in our documents that can be filled out, and that just needs to be emailed to us or anybody else within that 45 days. So on 11/59, on the 45th day, that email comes through with that property on it. Perfect, no problem. Everything is good. Then the next thing is you have to close on that within 180 days. Well, that's usually not an issue either. We don't really have problems with anybody saying, oh, I'm not going to be able to close by my 180th day. But what really needs to be focused on is that these 45-day and these 180-day limits are carved in stone. There are no extensions for any kind of issues. Oh, well, it's a holiday. Oh, it's a Sunday. Oh, I'm going to be out of town. No, that doesn't matter to the IRS. Those dates are carved in stone. Now, they can be extended if there is a presidential disaster declaration, but that's tough to rely on for any type of planning purposes. But that can come into play, and sometimes is very important. And with the amount of natural disasters we've been having, either through hurricanes or fires, that has been a large amount of areas that have had presidential disasters. Oh, and flooding. So it does come up. But something else I want to mention about the 180th day. So if you're closing, if your sale or your exchange is starting after October 15th, your 180th day would be past April 15th, which is the filing deadline for taxes. And you can't file your taxes before you complete your exchange. That's very important to know that. So if you're not going to close on that replacement property until the 180th day, and that's going to be like April 20th, you just need to file an extension for your taxes, which moves that deadline to October 15th now. So that takes care of that problem, but that is an important issue. So the time requirements, you sell the property, money goes to qualified intermediary, you have 45 days to identify, 135 days beyond that to close on the replacement property. So that's very straightforward. And those deadlines are very, very important. Now, the identification rules. You can identify 3 properties of any value. And I recommend this rule for somebody who's selling a single property and buying a single property. That way you have a primary property identified and potentially 2 backup properties in case that you find something wrong with that primary property. So the 3 property rule is great for that. And I recommend its usage there. The 200% rule, that's the second rule that comes into play. And this is usually for somebody who's going to sell one asset and maybe buy multiple replacement assets. And the 200% rule allows you to identify any number of properties, but the combined value of those identified replacement properties is limited to 200% of the value of the property you sold. So if you sold a property for $1 million, you can identify 10 properties worth $2 million. But if it's 2.5 million, you've blown the 200% rule and you won't be able to use it. Now, the last rule here is a rule, but 99.9% of exchangers don't use this rule. This is usually for people or owners that are sophisticated multi-property owners. If they're doing a portfolio exchange of multifamilies, or it's a REIT that's acquiring a large number of properties, this rule requires of all the properties identified that 95% of them were acquired. If you only acquire 94% of the properties, you have a taxable event. And that's the reason why that we don't find very many people who can use the 95% exception rule. So that's usually for much bigger players. Procedure for identifying the replacement property, it's got to be done in writing, unambiguously describe the property. You can't just use an apartment building. You actually have to include the unit number, signed and dated by the taxpayer, received the 45th day, or postmarked by the 45th day, and delivered to the QI or a party related to the exchange who's not a disqualified person. And that's not a huge list. So that's something that is very rare. Sometimes people send the identification to their attorney. That's not going to work out. You really need to do it for the to the QI. A common mistake is only identifying one property. I recently had a client who did this, and he identified it on his 45th day, and he only has that one property, and he's looking at that property closer. He's not liking it very much, but he really doesn't have too many outs. If he doesn't buy that property, he has a taxable event, and he doesn't want to do that. So that's why you use the three property rule, the 200% rule. You identify more properties so you have backup properties in case the primary object is not available or something goes wrong, you don't like it. Additional strategy, purchasing multiple properties in the aggregate that complete the equity and the finances. That's a great option as well. So, identifying more than one property, and you can put all the debt on one property and just use the other one as tax. So the one property pays off the debt and the other property is pure income. So those are nice options as well, and other strategies that can help out. Exchange vesting issues. Basically, the rule here is that whoever sells the relinquished property has to be the same person who buys the replacement property. Basically, it has to be the same taxpayer. So if a corporation sells the property, a corporation has to buy the replacement property. One of the exceptions here is if an individual is selling the property, they can purchase the replacement property in an LLC as long as they're the only member of that LLC. Then that's considered a disregarded entity by the IRS, and that's a valid approach. Some people, I've had people approach me saying, well, we want to split up when we're selling the properties, but we're in an LLC or a partnership. They've been filing partnership exchanges for many years. Well, you don't actually have, when you're a member of an LLC or a partner in an ownership, you don't actually have an interest in real estate as required by the 1031 exchange. You have an interest in an entity that owns real estate. So you're not separate. You are grouped. You are in that partnership or in that LLC or a corporation. And that can raise all kinds of issues. And usually when people want to go their separate ways, in a partnership or LLC, that's available and that's an option, but corporations generally not. Because corporations, if you break up a corporation, the feds and New York State view that that action generates a phantom tax, that whatever that corporation, be it an S or a C corp owned, is going to be taxed by the feds and the state at the value it was when you broke up that corporation. And that can be a bad tax bill. Historically, when 50% of the ownership interest in an ownership does an exchange, that can still allow for it to move forward. But the Tax and Jobs Act modified that, and there's now a technical termination for rules for partnerships. So that's something to talk to your tax advisor or CPA about, because that can make things very, very difficult. So what we talk about sometimes is what is known as a drop and swap, where you drop an LLC or a partnership before you do an exchange so that everybody can go their separate ways. You drop out of the partnership or LLC and redeed the property as tenants in common. Well, that allows for everybody to go their own way in a 1031 exchange. But I was recently at a tax conference, and a New York State tax attorney that we work very closely with said that New York State is not excited about drop and swaps. So if you are in a LLC or a partnership, you need to plan ahead and break that partnership up or that LLC up at least a year or 2 years prior to selling that property, because the New York State will view that as a step transaction and try to disallow it as a 1031 exchange. So that's something to look out for. And this comes up all the time with families, family ownerships, family don't get along, or partnerships go sour. They are big problems. And there are other options below. You can buy people out, but then that requires cash that may or may not be available. Or you can do what is known as a swap and drop, which means the partnership or LLC stays together. They sell the property, they do an exchange into multiple properties. And then once they're done with the exchange, they then break up the partnership and deed each of the property to the members or the partners after that. And that's more acceptable under New York State and federal rules. But the IRS really hasn't been focused on the drop and swap. But the swap and drop, where you stay together, and break up afterwards, that's a much cleaner transaction. And the IRS and New York State don't have a problem with that. Here's something that comes up sometimes. If the replacement property isn't going to be available, and the exchanger wants their funds back, well, there are limitations on when they can get their funds back. And this is part of the 1031 regulations that we follow. And if there were properties identified in that 45-day period, but none of them could be acquired, we have to hold on to that money until the 181st day, when the exchange has expired and the funds can be returned to the exchanger. And I've had any number of people say, well, I can't buy my properties. Can we get our funds back? And the answer is no, not until the 181st day. But if at the extent of the 45-day period, all identified properties have been revoked and there are no identified properties, then the money can go back on the 46th day. And that's a very important aspect. And some people will just do a 1031 exchange as an insurance policy if they can find something. If not, they'll just pay the taxes and get their funds back after 45 days. So these are restrictions, and this is what makes a QI a QI, by following these restrictions. That's what's important, and that's why presumptions of validity exist, because the safe harbor restrictions keep the transactions within them. We've already talked about these possible replacement options. Obviously, the first one, normal real estate, triple net lease properties, 7-Elevens, we showed some of those in the examples, the TIC and DSTs, the REIT and UPREIT, those are a little bit unique, and but they prevent any 1031s beyond that. And when shares are exchanged into the partnership units are exchanged into REIT shares, then that's a taxable event. So that's something else that's very important to look at if the property is moved into a REIT. TICs and DSTs as replacement properties, these can be very helpful in terms of flexibility, because these DSTs are easily and quickly identified and can be dealt with quickly. So these are sometimes what people will look at if they're having trouble finding replacement properties as a place to hold the properties. Now, the DSTs, the problem there is that it allows access to debt, but you're no longer in charge. The sponsor will decide the hold period for the asset, which can be 3, 5, 7 years, but it's still mailbox money, but you don't have control over the asset. And you'll find out when the sponsor notifies you that it's time to sell the property. That's when it changes hands. Tenant in common interest, these are the undivided interests, and this is the one that is less used now because of the restrictions on it, and it's very infrequently found now. That's why DSTs are much more popular, because a lot more flexibility for the sponsors and how they're financed. These are the pros and cons of DSTs. Easy to identify, close on. You can get debt based on the financing on the property, the sponsored property. And it's a really good option for some people. I usually recommend DSTs. Let's say you sold a $5 million asset, but you're only able to find, you were selling a $5 million asset, but you only found, let's say, 4.25%, $4.25 million in replacement property. Well, then you might have $750,000. You can't find a property. You could invest it into a DST, and that's a good way to handle that. Reverse and improvement exchanges. Reverse exchanges. This is where the replacement property is acquired prior to the relinquished property being sold. These are handled by a special team within our company, and these give some flexibility to 1031 exchanges. Improvement exchanges, where you might find a property you want, but you want to use 1031 funds to do improvements. That's a parking exchange as well, and that can be handled and executed as well. Or reverse improvement exchanges, those are a viable option as well. These are highly complex, and they cost more than normal forward exchanges, but these are options if the circumstances dictate, and always happy to talk about this, but these are much fewer and far between. But as an IRS revenue procedure in 2000, it created a safe harbor for parking exchanges. So there's a structure out there, but they can also be performed outside the safe harbor, which is doable, and the IRS allows it sometimes, but the presumption of validity is not there, and it could be considered a taxable event. When you do these reverse exchanges, we form what are known as EATs, accommodation, exchange or accommodation title holders. They're usually an LLC that holds the replacement property while the exchange is occurring. These are why some of the additional costs are involved, because we have to hold on to these funds. We have to form another entity, and it just costs more money. So these are additional complexities when you're doing a reverse exchange. The identification period is still the same. You purchase that replacement property prior to selling. You have to identify the property that's going to be sold, and that's easily done. And then you have 180 days to sell that property. So that deadline stays in place as well. So like I said, the 180-day process is still in place. There are some the contract dates and closing dates are different for these, and they're a little more complex, but they also can extend some time frames as well. Replacement property is acquired by the accommodation title holder, and it's the sole member. This allows for some financing to be involved, but again, that's more additional complexity that comes into play. Now, sometimes why we do them in LLCs is we transfer the LLC ownership and not the deed to the exchanger, because that avoids sometimes transfer taxes, and it's a lot easier to do. So that's why we usually form LLCs to form these structures, and that's just another complexity. And again, normal exchanges usually cost between $2,000 and $2,500. Reverse exchanges can be $6,000 to $10,000, depending on the complexity. And you can see that's quite a bit more money than a normal straightforward exchange. And there is the end of my presentation. Thank you very much for attending, and I'm happy to take any questions at this point in time. And I'm sorry I ran a little bit long there.
No, thank you so much, David. Do you want to end your screen share?
Yep, I'm looking on how to do that right now.
And this is so incredible. I mean, thank you so much. Just when I
went over a lot of stuff.
It's really, really thorough, because when I listen to your each slide, and I jot down my question along the way, and then the following slide or two, you actually present the answer to the question I already jot down. So
that's my goal. That's my goal.
Yeah, very thorough. Actually, really, really thorough. And so I want to let everybody know that I quickly repost David's contact information right on the chat box, and my information on the chat box. So feel free to contact David or me, whenever you need. I'm a real estate broker, and I'm not an expert on everything. However, we are expert on the connecting the client to the expert in the specific field. And when David went through this 10 loan exchange, it's actually a very complicated concept. So I don't know whether anybody has any questions. So now we can open to the Q&A if David has a bit of time. But I know there are a few questions. Great. My question is actually very simple, and oftentimes it's a client asks, because all this presentation content, it goes really deep, and most seller or individual sellers, they are really not familiar. They rely on their seller. Mm-hmm. They rely on their attorney, but attorney don't necessarily educate this much. So the very basic question, when I went through this presentation, I realized that it's really important for any seller or investors to have a consultation with QI, the expert like you, even before like selling the properties or plan ahead. But usually most people don't do that. That's what I realized that.
And I'm happy. I'm happy to answer questions. There's no cost for my time to chat about what your situation is and how a 1031 might work for your transaction or the property you're looking to sell. So I'm happy to get on the phone and talk to anybody about those possibilities. I'm happy to be a resource. If you don't use us as the QI, that's fine too. I know that we're a very good company. We're a subsidiary of Truist Bank, and as such, we're now owned by the 6th largest bank in the nation. So we're very secure. The funds, when we do hold them, they're put into a money market account, so they're not invested in any way, shape, or form, and they're put into an account tied to the exchanger's Social Security or EIN. So if anything happens to us, highly unlikely, and there's a bankruptcy, those funds are still in their name. And so there's no problem with that. And since we got acquired by Truist, our $5 million bond went to $250 million. So we pretty much cover almost any amount of proceeds that we're holding.
Great, you just one step ahead of me. So along your presentation, what happened to those funds that accrue interest that you put in the money market, till like 180 days?
Sure.
Yeah.
Well, what ends up happening is we, because of the current interest rates, we will pay some interest to the exchanger, depending on the amount of proceeds we're holding. Generally beneath $3 million, I think we hold on to the interest, but above that, we pay them out. And to some degree, it's negotiable. I had a client who did I think it was a $2.8 million exchange. And we were happy to negotiate some of the interest being paid to him. And he was happy with that. And, I think I now have that person as my client for life because he's like, well, that's fair to me. And, we generally, our fees don't cover what we do as a company. Generally speaking, we make our money off of the interest that we're holding. And if you think about it, during the era of very, very cheap money, at one point in time, I think we were making 0.3% on the money that we were holding, which really wasn't a great amount of money. But now that things have changed and interest rates are 5% at the Fed, we are able to share some of that interest with the exchangers, depending on the volume and the amount of funds that we're holding.
Okay, and the next question, I don't know what I mixed. So for the exchange, I know it's a basic question, but can the replacement property be located outside the U.S.? If your relinquishing property is
no,
no, right?
Well, it's a little more complex, but generally speaking, no. Okay. If you're selling a property inside the United States, you can exchange anywhere in the United States, Florida, Alaska, and here's 2 additional places, Guam and America Samoa. You can exchange in and out of those areas, but I've never done an exchange to America Samoa or Guam. Now, a place that I do get questions about frequently is Puerto Rico. And Puerto Rico is part of America, but due to its treaty structure, it does not fall within the 1031 allowances. So you cannot do a 1031 into Puerto Rico or out of Puerto Rico. But the other place I failed to mention is also the U.S. Virgin Islands. That is another eligible place. I have talked to clients who have exchanged out of the United States into the U.S. Virgin Islands. So that is an option. But generally speaking, you do an exchange inside the United States. Now, another quirk of that is if you own a property in Canada or someplace else in the world, you can do an exchange out of that property into another place in the world. Those are considered like-kind properties. International property, that's okay. But United States, it's got to stay within the United States. Puerto Rico, not Puerto Rico, but U.S. Virgin Islands, Guam, and American Samoa.
Great. And the last one, which so the 45-day identify rule. Oftentimes, sometimes people miss it, right? So the way for the seller is to send a written notice to QI for the with the identified properties 3 and 200% rules through the email or through a letter, right? So can this be somewhat flexible? Like especially let's say in the market when the market is really fast, right? Oftentimes the buyer bidding war, not the current market, but if we talk about back to a few years ago, the Manhattan market was so hot or broken. It's not necessarily you have to give me 3 identify. I might not, be the winner. So, but as long as I catch 180-day closing day, right? This 45 days is flexible. Actually, speaking of that, I'm going to turn off the recording. 1 second.
Okay.